Hello everyone, this presentation will cover the investments trading simulation. My team was formed by Ashley Contreras, James Stevens, and myself, Jennifer Rocha. We're going to start with an overview of the mutual fund prospectus. We will then proceed to look at the investment strategies, the returns of our portfolio, and even a comparison of our portfolio against our benchmark company. The management team was formed of 3 investment agents, Jennifer, Ashley, and James. We decided to invest in securities with high volatility, high popularity, and high returns in the market. The main objective for us was to generate profit. In order to do so, we invested 60% of the investment into stocks, 30% into bonds, and 10% of our clients' investment was actually kept as cash. As far as our target risk and return, we set this up by looking at our performance benchmark. The benchmark for us was actually Fidelity OTC, and we decided to choose this company because their portfolio was very similar to ours. Therefore, the target return was set to 10%, the target standard deviation was set to 18%, and the target beta was set to 1.1. As far as the target investors, we decided that middle-aged to older generation investors would probably be most attracted to our portfolio. This is because we aimed to have lower risk, and we know that the older generation investors are very risk averse. In terms of our investment strategies, we focused on diversification and risk tolerance. Diversification was a strategy from the start. We knew that in order to be the most profitable for our clients, we had to avoid putting all eggs in one basket, which is why we focused on varying fields such as technology, automobile, and banks. Eventually, however, we also dived into the science and technology sector, biotechnology to be more specific. Throughout the simulation, we noticed that due to the COVID-19, there was a huge impact in the market. The market was highly volatile, and we decided it was time to tolerate some risk. We actually implemented this risk tolerance strategy because of the middle-aged prospects. We know that they are a little less risk averse than the older generation and would be more tolerating of this strategy. We invested into the financials field, the medical field, and the biotechnology field. When we decided to invest into the science and technology market, we discovered the company Mirena Biotech Incorporated, also known as Moderna Incorporated. This company focuses on discovering and developing drugs that can be injected into patients to help them create their own therapies. So basically, as I previously stated, the COVID-19 had a huge impact not only on the market but worldwide. So we definitely saw the opportunity that companies like these would be getting to increase their stock price. So we moved on to do more research on this company, and on their news section, we actually saw that they were working on a vaccine in order to prevent the coronavirus. We also saw that this vaccine was actually reviewed by the FDA, which gave us even more of a positive perspective on the company. So we definitely decided to invest into it because we saw the opportunity there was in the market for growth.
So now we're looking at the absolute return, the overall percentage gain or loss on our portfolio. And our portfolio had a loss of 18.45%. One of the biggest causes of this was some stocks that we decided to short sell whenever the market was declining. And these stocks were declining as well. And we believed that these stocks would continue to decline, but they ended up rebounding, increasing in value. And so we ended up losing on stocks like WSP Holdings and Trade Desk Incorporated, two stocks that we short sold, and ended up losing big on those two. And we also bought some stocks that seemed like they would start to increase in value throughout this whole situation, like Inovio Pharmaceuticals, which started to increase for a little while and then ended up decreasing, and overall ended up being one of our bigger losses as well. But we did have some stocks that showed positive returns, some good stocks for us, such as Moderna Incorporated, which had a return of 70.18%, and McDonald's, which had a 35.54% return. And Moderna was a big one for us because we had bought 2,000 stocks, and when we bought those 2,000 stocks, it was selling for $27.53 a stock, and by week 9, the share price was up to $46.85. So we ended up making a profit of $38,640 on that stock alone. We also had some other stocks that performed well that we either bought at the beginning and held, or we bought at some point during the project. And those include something like Netflix, Walmart, and Amazon, which we all bought at the beginning and held on to them throughout the 9 weeks. And Netflix had one of our better returns at 9.94%, and Amazon had a good return at 9.61%, and Walmart had a pretty good return at 7.74%. And then we also bought Gilead Sciences during the project, during the 9 weeks, and that ended up having an 8.43% return. So our return could have been worse if it weren't for some of the good stocks that we had that made us profits. But overall, we did have a negative return. So now we're looking at the risk-adjusted return, and the risk-adjusted return allows us to look at a portfolio and take in the expected return of a portfolio, the risk-free return on the market, and the risk on the portfolio, and it allows us to decide, is this portfolio worth the risk given the potential return? But in our case, we have our returns already, so we're looking at our returns, the risk-free rate, and the risk of our portfolio to decide, was this portfolio worth the risk given the return? And so how do we measure that? We looked at the Sharpe ratio, and basically, so if the Sharpe ratio is above 0, then you could say that that portfolio might be worth investing in. It might be better than investing in a risk-free investment. If the portfolio, or if the Sharpe ratio on the portfolio is above 1, then you could say that that portfolio is probably worth investing in. It's probably better than a risk-free investment. When looking at our risk-adjusted return, our Sharpe ratio, we had a negative Sharpe ratio. It was negative 2.77, which means basically our portfolio is not worth the risk given the return. There's too much risk and the potential return is not high enough, which in our case, the return that we had on our portfolio was negative. So obviously any type of risk wouldn't be worth it. Even if the risk was 0, it wouldn't be worth a negative return. So looking at our portfolio and our risk-adjusted return, the risk-adjusted return can show us that it would have been better for us to invest in a risk-free investment and to make a small return but without the risk. Okay, so now looking at the number of days that returns were positive on the portfolio. So the number of days that we made a profit on the day, the number of days where our portfolio increased in value throughout the day. And I mean, just looking at our absolute return, you could tell that we didn't have a lot of days with positive returns, especially at the beginning of the 9 weeks of holding the portfolio. Most of our days were negative returns, and at the beginning and mostly throughout the 9 weeks, returns from day to day were pretty volatile. Sometimes we'd have a day with a positive return and the next day have a negative return, and it was very volatile on the scale of those positive and negative returns. Sometimes we'd have a very big positive return and then one day have a very big negative return. But either way, it was very volatile. But towards the end of the 9 weeks, we started to get more days with positive returns, especially in the 2 of the last 3 weeks, especially in week 7 and week 9. During that week, we started to have a lot of days with positive returns, which shows as to why our returns for those weeks were positive. But still, the returns were very volatile, and as you could see in week 8, we actually had we ended up with a negative return for the week because we ended up having a lot of negative returns each day, even after week 7 when we were having pretty good positive return days. But like I said, it was very volatile, the returns the whole time. The greater percentage of our days ended up in negative returns, but towards the end of the 9 weeks, we started to get back on track and started to show days with positive returns, started to show more days with positive returns, which shows up in our weekly returns as to why in week 7 and week 9 we had positive returns for the week.
We decided to use the Fidelity OTC portfolio as a benchmark to compare throughout our trading. Above are the Fidelity share price and return by week compared to the return and value of our portfolio by week. As can be seen, both of our portfolios suffered negative returns for the first 5 weeks. Fidelity managed to get back on track with positive returns in week 6. Our portfolio was starting to get on track the last few weeks with positive returns and could have continued to show positive returns. Both our portfolio value and their share price ended worse off than they started in week 1, yet around week 6. Fidelity's stock price started to go up again, although it has not reached its starting value. Both portfolios look promising with positive returns, which I think would have continued to happen over time. The graph shows the week-by-week returns of Fidelity OTC portfolio and ours. Right away, you can see how volatile returns during this period for both portfolios. Both portfolios had erratically negative weekly returns until both eventually boosted positive weekly returns. Although both portfolios were positive weekly returns in the final weeks, they were still very volatile, especially ours. However, the report ended on a positive return increase from the previous week, which was negative. So our portfolio was improving and could have kept showing positive returns. Fidelity ended on a positive return for the final week, but one that was less than the previous week, which could be a sign of equalizing or just more volatile. The graph shows the stock price of Fidelity shares and our portfolio value as a percentage of the value in week 1. As seen in the previous graph, there's a decline in the value of both our portfolio and Fidelity shares until a point when both portfolios start to reclaim some lost value. While our portfolio value decreases more the second to last week, we had an increase in the value in the final week. As shown in the graph, neither portfolio reached their starting value by the final week, but both demonstrated positive outlooks. Stock simulation was very helpful and StockTrack was a great starter platform. Risk tolerance strategy for the middle age group. First step, ask the client of their financial situation. How much can they afford to invest? Second step, asset allocation. How much to invest into stocks, bonds, and money markets? Third step, portfolio diversification. Buying more stocks and leaving more cash on hand. The returns did not meet our expectations and decided to sell the negative stocks for medical and biotechnology. The stock momentum stalled after breaking news of COVID-19. If we had the opportunity to redo the simulation, we would be less risk adverse. We learned various investment strategies, how to read and prepare trading reports, buy and sell stocks, view open and close positions. Market timing must stay up to date on news. Wall Street is an economic indicator. If the sales are positive, so are the stocks. This concludes our presentation. Thank you for your time. Stay healthy and safe.